how does a structured finance guy evaluate what's going on in the White House, and what, if any, decisions do you make as a result?
I mean, we look at it as basically an opportunity. I mean, clearly, anytime you get change, it's going to be good. I mean, those create opportunities for us. I mean, I think we've had a little bit of a honeymoon, as I was saying to you earlier, with the transition, and it's created a really low volatility environment, and that's been fantastic for our strategy. Usually, we can do a lot of interesting things in a low vol environment. I think now we're actually entering a phase where basically some of the challenges that's facing the White House in terms of getting policy done is going to be a little bit more difficult. It's going to force us to think a little bit more critically about how we actually approach the market. But we like change, and I think basically, it will continue to create new opportunities.
Some of the things that you have to think about making structured finance investment include changes in tax policy, for example, changes in policy, in housing policy, the reform potentially of the so-called GSEs, Fannie and Freddie. When you say legislation may become difficult, I'm paraphrasing, does that mean, in your mind, those things are off the table, or are we not there yet?
Well, I think there's what we're doing is we're adapting. I mean, so we actually had an environment where actually we had a lot of regulation coming to the market, and actually in a lot of ways that would actually look very market unfriendly to an investor. And in some ways, what it did is it created opportunities for us that we've talked about in the past, where
risk transfer, say, from the FHFA risk transfer program.
Exactly, it gave us a chance to step in where banks are actually being pushed back and away from the markets. People like investors like ourselves got to step in and actually fill those gaps, and we got to price the market according to basically the returns that we wanted. So as much as that might look like a more challenging environment for an investor, it was a good environment for us. Now we actually have an administration that's kind of actually pushing a little bit back on the regulation. It's opening up the markets a little bit more. I think what it's going to do is it's going to create more volume. It's going to allow basically sort of probably more opportunity for investments. It's going to allow the banks to basically go back to more traditional lending. We'll adapt to that.
Where the government becomes a smaller part of the mortgage market.
That's right. That's right. And so the way we'll adapt to that is it'll probably create different supply dynamics around basically the markets. It'll probably allow a little bit more flexibility for us to do more creative things that were more restrictive under the former regulations.
Some of that expectation, if you will, is based on the notion that the president will be able to execute the priorities on his agenda. And not just the president, the people whom he surrounded himself with in cabinet and at the White House. Given the turmoil that we're witnessing today and yesterday and in recent weeks, do we need to reconsider the probability that those things actually happen?
For sure. I mean, the market's doing that today. I mean, so I think what we're doing is we're recalibrating, and basically a lot of the expectations we have for things getting done are getting adjusted. It's going to become a little bit more difficult environment.
Do you think about these things the same way as an investor as you do as an American?
Oh, for sure, for sure. I mean, some of the things that actually we think about a lot, which again we've talked about, is what's going to happen with GSE reform. What's going to happen with basically mortgage policy.
Yes.
And we've been very active, as we talked to you about, in terms of like the risk transfer programs around Fannie and Freddie. As a taxpayer, I think basically those are fantastic programs. They've been great for the taxpayer. They've been great for the investor. And
notwithstanding the number of critics they have.
Well, the GSEs may have certain critics, but I think the programs that they put in place to basically move risk away from the taxpayer have been mutually beneficial for taxpayers and for investors. Okay,
so what then happens? There's a higher degree of likelihood that we see GSE reform, or a lower degree of likelihood that we see GSE reform?
I think there's a high degree that you're going to see the volume amplified around GSE reform for sure. I think that there's going to be we're going to take inventory.
I'm talking about the privatization of Fannie and Freddie.
Yeah, yes. I think for sure you're going to get basically a much more elevated debate. I think you're going to have to take inventory of what's working and what needs to be changed. I mean, I think there's a real sensitivity about basically allowing the GSEs to go back or becoming a politically sensitive tool for policy, and I think that will be part of the debate. I think the things that have worked for the taxpayer, I think you have to actually consider continuing.
In the meantime, I want you to talk to me about how you're planning to trade the shrinkage of the Fed's balance sheet, because that involves Fannie and Freddie, not directly, but involves Fannie and Freddie debt.
For sure. I mean, I think that we think obviously we're going to go into a phase where the Fed is going to have to reconsider what they're going to do with their own balance sheet. There's obviously been a tendency to think about reducing the exposure they have. It dovetails with some of the things that sort of the new administration has come in and started to actually prioritize in terms of the government's role. And I think that will actually put pressure on mortgages in the future, and I think it sets up for certain trades in terms of basically being short mortgages relative to treasuries if basically the Fed decides to actually reduce its balance sheet. Short
the MBS or short agency bonds?
The MBS.
Like, Fannie and Freddie issue, the agency MBS.
That's
so
right.
So it involves, you're going short agency MBS, buying treasuries, and hoping to capture the widening of that spread.
That's one way to do it, yeah.
What are some of the other ways?
I mean, there are other nuances in there, but that's the primary trade that I would suggest.
So that sounds like it makes perfect sense. It's a basis trade.
That's correct.
Basis trades have, as you know, have had a history of blowing up, right? For long-term capital management, they blew up for Deutsche Bank in the most horrible way, and for a number of other people as we entered the financial crisis. What could go wrong in this trade?
I mean, you could have, obviously, you could have supply and demand imbalances. So we were talking about it. I mean, you can get a rally in rates. You can actually get, a resurgence in terms of refinancings. We've actually had a rise in the equity for REITs, and REITs are big buyers of mortgage debt. So you have to pay attention to other dynamics in the market, like, are the REITs, residential mortgage REITs, able to issue equity, which they have recently. That actually creates another source of demand for agency MBS. So the way that we would look at it would be very tactical. You have to trade these bases. You have to actually be very, nimble around basically your positions around it. I think as a core,
it's not a set it and forget it.
No, it's not.
So
it's absolutely not.
How do you time it? Do you wait until the Fed announces its plans for the shrinkage of the balance sheet? Do you wait until those mortgage bonds begin to roll off, and the Fed passively shrinks the balance sheet? How do you time it?
It's going to be very difficult to time. I mean, I think you have to pay attention to the discussions that the Fed continually has around policy. I mean, it's something you're going to follow in the headlines. So you're going to have to really time it around basically headlines and interviews and speeches that the Fed's giving.
And how much of a widening do you think we will see ultimately between mortgage bonds and treasuries?
I think our estimate is it could be basically 1 point, which is actually, depending on how you actually position that, with leverage, it could be a pretty meaningful return.